Good afternoon. We'll get started in just a couple minutes. So welcome to the last webinar in this series. Today we're going to cover capital budgeting tools, net present value, and internal rate of return and payback period. So it should be a scintillating lunch, and hope that it helps to answer a few questions about making financial decisions. So, great, and just to remind everybody, again, let me make sure I have everything. Yep. So if you have any questions, feel free to put them into the chat feature once again as I go along. Otherwise, and I'll try to answer them. If you have other questions, later on, feel free to email me. I'll be sending up a follow-up email since this is the last series, so I'll have my contact information if you have questions going forward. And I would also, like to, I just want to make sure that I do have the videos up, or I'm starting to get them up, although I'm going to have better edited versions of them up, hopefully within the next couple of weeks. So with that, let's launch into capital budgeting tools. So capital budgeting is the process that we use to determine which capital asset investments are likely to be beneficial in the long term. And when we talk about capital assets, we're really talking generally about long-term investments, things like new equipment, new facilities, other infrastructure upgrades. And in our assessment in capital budgeting, what we're taking into account that we haven't really taken into account as much with some of the other tools we've been doing is the time element of these investments. Often these are investments that are going to have payback periods over 5, 10, 20 years. And then also that risk element, right? Because when you're looking at things that are going to pay back over more time, we don't know what'll happen in the future as well as we know what is likely to happen in the shorter term. Also over time, you have other more alternative things you can do with your money than you may have in the shorter period of time. And so there is this risk element also that we incorporate in many of our capital budgeting techniques. So just sort of to remind everybody what we've sort of covered and then how this is related. We talked about partial budgets, and that's where you just only consider the inputs, the revenue streams and costs around a very specific, narrowly defined change you want to make. So you don't consider any of the other revenues, any of the other expenses in your business. You only look at the change in revenues and change in costs for a very specific thing. And so that's usually used to evaluate sort of the profitability or cost effectiveness of a very specific change, like should I lease or buy a truck? And it's generally focused on immediate changes or smaller changes. You do a partial budget. Enterprise budgets, you use to evaluate the profitability of an enterprise within a system. Should you produce fresh market apples or peaches? And generally, like an enterprise budget is focused on developing estimates for annual returns. Now, when you do an enterprise budget, you might have multiple enterprise budgets if you have different costs and revenues, like for different stages within that business. And you want to capture that, but generally that budget is for a year. So capital budgeting is a little bit different because you're looking on that return on longer term assets. You're considering that time value of money. You're considering risk and economic costs. So is an apple orchard or a peach orchard a good investment, for multiple years? You often do need enterprise budgets, and having that kind of data to be able to do capital budgeting, because it is reliant on having good data, or at least as good data as you can come up with, but it's sort of a step further. So there are 3 capital budgeting tools I'm going to cover at lunch today. And these are net present value, internal rate of return, and payback period. So let's start with net present value, and that's one that you often, some of you may be familiar with, and it's probably one of the most common tools that's used to really assess long-term investments. And it represents that difference between the current value of money flowing into a project and the current value of money being spent. And so the amount of money being spent is your investment, that the investment that you're making today, how much over time am I going to get back from that investment? And you also are looking at, then you're taking into account though that time value of money, because it recognizes that money in the future is not worth what money that you have in your hand today is worth. So one of the key things that you see in net present value calculations is that you have what they call a discount rate, and it's essentially an interest rate. It's a percentage, and you determine that percentage, and that is that percentage that you use, that you discount your future flows of income to. They adjust for the risk of an investment opportunity, so you would use a higher discount rate, a higher percentage to discount, more the money that you'll get in the future, because you're less sure you're going to get it in the future, right? There's that uncertainty. Whereas if you use a lower discount rate, a lower percentage to reduce future streams of payment by, you're more confident that you're going to get that stream of money in the future. And then also to account for that time value of money, that money that you're putting into this investment 20 years from now, you could have put into another investment. So it captures sort of that opportunity cost, if you will, of money. So the formula for net present value, one way to think about it, it's the today's value of that expected future cash flow, and then also subtracted from the today's value of that investment, that initial investment you're making. The formula, it's got that little summation. So it's net present value is the summation of that series of future cash flow payments, and you take that cash flow, like whatever you're in it. So say like in a year, you've got $100 you're investing today, and you're going to generate $10 a year for 13 years. So the cash flow is $10, right? So the initial investment would be the $100. The period of time is 13 years. And then you're setting a 5% discount rate. And that is either that's the other investments that you could put that money into, or it's your assessment of that risk or what you would need to get in order to feel like that was a good investment. So for example, if you did not use net present value, if you just calculated the stream of payments, you would see that $10 over 13 years would give you $130, that if you had no discount rate. And then, because you put that initial $100 in, that would give you $30 of profit. So that, that would be assuming no discount. The net present value, on the other hand, would be that negative $100, your negative initial investment, plus that $10 the first year divided by that, reduced by that 5% discount rate. And then that $10 plus that $10 in the next year reduced by that 5% discount rate, but squared. So for the second year, plus the $10 divided by that 5% discount rate cubed. So you basically, and then you sum up all of those, that stream of future payments discounted by, by that discount rate you put. And you sum those together, and then you see, in this case, with that 5% discount rate, you actually have a $6 loss at the end. So instead of a $30 profit with no discount, it's a $6 loss. And that $6 loss more accurately reflects, the fact that you could have gotten, that this is not as good as, as if you had put it into like just a 5% investment somewhere else. It's showing that it's not, it's not as strong an investment. Whereas if you didn't take net present value, you might think it actually was a profitable investment. So yeah, as I said, the first point is you really want, the one of the values of net present value is that discount rate really adjusts for risk. And and that's a necessary thing to do because not all projects or investments have the same level of risk. And so, like for example, with orchards or whatever, you could, if you put that money, into an orchard, it could be like 5 years down the road, those apples are not worth what you thought they were going to be worth, right? So by discounting the future flows, you're basically saying there's more uncertainty there. So I don't want to count on getting that full amount that I think I'm going to get today. I think it's going to be worth less. Inflation will make it be worth less. But the risk actually, it's because there's this uncertainty for a future investment. If you use a higher discount rate, you count money that you're going to get in the future less, and so that will make it so that it would have to be even more profitable for you to consider this to be a good investment. And then adjusting for time, the other reason you put the discount rate is because of inflation, alternative interest rates, opportunity costs. Money is more valuable the sooner it's received, because the faster you get your money back, the more you can put it into something else, the more certainty you have about those investments. So if you have $1 million today, you have $1 million and you have a lot of opportunity with it. $1 million received 5 years from now, like a lot can happen between now and 5 years. So, inflation could make that money worth a lot less. Other alternative investments could have made that money worth a lot less. So, so that's the other reason we use the discount rate and net present value. So one way to evaluate a net present value calculation is a project whose net present value is positive or above zero should be considered, because if you've got a positive net present value, you have fully accounted for the opportunity cost, inflation, or risk. Now, so it's something, it's a project that it passes that test. And if you have more than one project that have positive net present value, the project with a higher net present value should probably be preferred. So let's look at a net present value analysis in action. So if you were going to use net present value on your farm, the first thing you would do is you would start with an enterprise budget, and then you would determine the life of the investment and the predicted income streams, both positive and negative. So if you're putting in an orchard, you might have negative income stream the first few years, right? You're putting money in, but you're not getting any revenue back. So not every income stream from an investment is going to be positive right away. And then you determine the discount rate. And as I said, if you make the rate lower, you are assuming that there's less risk and that you're setting the bar lower for this to be a positive a good investment, or you're making it easier. If you set a low discount rate, you're making it easier for this to be a project that you will accept. And if you set a high discount rate, you're setting the bar higher for this to be a project you would accept, and you're assuming that there's more risk in that project. So you have some determination about this. Then you would calculate that net present value, and then you would evaluate the project. And net present value is just one tool you would use, but it can be, it's a pretty powerful tool. So this is let's see if this will work. Yes, it will. Okay, good. This is a spreadsheet that one of my former colleagues, Matt Wells, developed to look at two different systems. A orchard, so two different orchard planting systems. One was Gala and one was Ida Red. And in this case, these numbers I think I've played with over the years, so don't look at the numbers per se. Like, this is not to tell you whether Ida Red or Gala is more profitable. It's just to show you how you can use this, this type of analysis to determine whether or not something is likely to be profitable in the future when you include that, when you take net present value into account. And so what you can see here is that, these are all of the assumptions that you would put into an enterprise budget, that you can put in, or you are the one that would determine, all of the variables that go into that analysis. And your assumptions about yields and your assumptions about prices are over here. I think he's assuming somewhere in here what you are gonna, yeah, your forecasted return per bushel, your and then right here is the discount rate. So he's assumed we've assumed a 5% discount rate here. And so at a 5% discount rate, with the assumptions that we have, this one is assuming that the net the net income, and this is before net present value, is 180,000 for Gala and 257,000 for Ida. Like, don't assume that that's actually true. It's just that these are, with the numbers that are in here. But when you include that 5% discount rate, the cumulative net present value is only 92,000 for the Gala and 131,000 for the Ida. They're both still positive. They're both showing, that these are investments that make sense. And you can see, like, he's created a graph that you can see every year. This is 0, this is negative, so that it's negative until about, I don't know, I'd guess like year 6 or 7, and then it becomes positive. And so, oops, let me go back here for a sec. Sorry about that. If you look at the next sheet, you can see here, this is very similar to your enterprise budget. So it's putting in the enterprise budget data. You're assuming 19 years of returns. These are your initial costs, and these are all of your revenues after that. That it's, he's assuming negative return, they're assuming negative returns the first few years. This is the annual net present value, and then this is the accumulated net present value over time. And then, so this is showing that at the end of 19 years, the accumulated net present value, it's positive at $92,000. And then this shows you the discount rate that's used every year. So you multiply with the discount rate, you multiply that by the net, and that gives you the annual, the non-adjusted amount. And then if you multiply that discount rate, you see this, at the first year, there's no discount because that's the year you have it. The net cash is 3,250, negative 3,250, and the net present value is negative 3,250 because it's the same year. The next year, you're reducing the value a little bit. And so this is what you're assuming, and then you're discounting that. So you're multiplying this 18,928 by 0.95 to get $18,027. And you do that every single year, and then you add all those up, and you finally get your total net present value, your accumulated net present value for that project. And then I think I went through this at one point. Let me play here. You can see, let me just scroll ahead, that as you adjust, so you have a 5% discount rate here. If I adjust it to a 10% discount rate, that changes, that makes the cumulative net present value drop, right? So it makes the project less, it's more risky at 10%. And so I'm assuming that, I'd have a lower return. I'm setting the bar higher basically for me to accept that project. Whereas if I lower it down to 3%, now my cumulative net present value is 120. It's much closer to the non-adjusted rate. And so, so I would determine as a business person where I felt comfortable about that discount rate. It could be compared to comparable investments that you could make. It could be, you might set the bar higher. If you make it 0, you can see they're both equal. And so your goal with this, with net present value, is ultimately to set a discount rate that you think is really reflective of the risk of the project, and providing that margin of sort of confidence that you're gonna actually get in the future the return that you expect that you're gonna get. So limitations to net present value is it does make a lot of assumption about future events that may not prove to be correct. You're the one that's building that model, based on your enterprise budgets and stuff. But it could be that, 10 years down the road, things really change. So the further out you're projecting the future, the less certain it is. Discount rate value is a judgment call. So the cost of the investment's projected returns are estimates. So it's only as reliable as its underlying assumptions. A lot of times people, many planners, you'll set a higher bar, a higher percentage for that net present value to give yourself an additional margin of safety, right? Like if it passes at, like 8% and it's still profitable, then that's, much more confidence that I'm actually likely to see that return, because I'm basically saying that future value is money is worth a lot less. And the other thing is you can't directly compare projects with net present value that have different time horizons or levels of risk. So if you've got a 5-year project and a 20-year project, you can't use net present value to compare those two, because the 20-year has a much longer time horizon. Internal rate of return is another tool you can use. It's very related to net present value. It's the discount rate, or that percentage, that interest rate that makes the present value of a project's estimated cash inflows equal to the present value of the project's estimated cash outflows. And so it's the exact same formula as net present value, but in this time you're solving for that interest rate. You're trying to determine what is that interest rate that would have net present value equals 0. And that will tell you what the minimum rate of return is that would make the project profitable or acceptable. It's kind of used to set a floor. So you would, and then you can see whether or not you think that's reasonable or not. So they're very closely related. You can see here, so for example, if you have $100 invested today and it'll generate $10 a year for 13 years. So I've got my initial investment of 100, I've got my 13 years of $10 payments. What's the minimum discount rate that'll make my net present value equal 0? And I can, in Excel, I can do that. There is a formula, it's internal rate of return. And you basically just take that, that stream of payments and the negative payment, and you type internal rate of return equals internal rate of return. It's actually pretty simple. And then the values, and these are the values, the initial payment and then the stream of payments, and you hit enter, and Bob's your uncle, it'll calculate it for you. And so in this case, it's 4%. So that's the minimum discount rate that would make this, this project, this investment actually, it needs to get over that bar to be acceptable. And so, so if I can get, if I really, I think, so that would be a way of also trying to determine whether or not it's riskier or less risky. So if you have a higher, if you generate something that has a higher internal rate of return, like a 8% or 7% or something, that's likely to be a less risky. And if you generate something that has an internal rate of return that's lower, that would tend to be a more risky project, because you don't know the future as well. So you're basically saying the minimum discount, if the interest rate goes above, like that discount rate goes above like 1 or 2%, the project's not going to be viable. That could be concerning. So remember that, remember we learned before that at 5%, when we did this exact same the same problem earlier, net present value was less than 0. It was not an acceptable project. So this one, it has to be, anything above 4% is not likely to be a viable project. So it's, it's not necessarily a highly lucrative investment. So if the internal rate of return is greater than the required return for the project, then you would accept the project. And if the internal rate of return is less than the required rate of return for the project, then you would reject the project, is how you would evaluate it. The limitations to this is that, once again, what is that required rate of return? Internal rate of return used to compare projects with different dollar amounts. It doesn't reflect that dollar scale. It just gives you a percentage. And so, so like something that's got like a 50% internal rate of return versus a 2% rate of return, but you don't know the actual like dollar amounts. And when used to compare investments with different time horizons, it doesn't capture the ability of a shorter period investment to reinvest profits in a different venture. And so it's got a lot of actually the same limitations that that net present value does, except that net present value does actually give you the dollar amount of profit, of profit that you're likely to receive in the future. Internal rate of return just gives you the percentage rate. And then the last tool that I want to cover today is payback period. And this is a slightly different. It's that an analytical tool that defines the length of time necessary to earn back the money that's been invested. And it refers to the number of years it takes to recover the initial cost of an investment. Payback period, if the farm has liquidity issues, so the shorter a project's payback period, the better it is for a farm because you're getting cash back quicker. So especially, for a lot of beginning farms and stuff, something that has a faster payback period could be necessary to get some cash into the business. Projects with a shorter payback periods have less risk about future uncertainty. And projects with shorter payback periods give the farm the opportunity to reinvest the proceeds in other investments. A limitation with payback period is, just doing a straight payback period, it doesn't account for that time value of money. So you're not, you're not discounting when you do a payback period. You're just looking at how fast will I get my money back. And then it doesn't really account for what happens after payback occurs. So it doesn't look at the remaining stream of income. And so it ignores an investment's overall profitability. It just looks at how fast are you going to get your return on your investment back, which is still important, but but there could be like a larger picture. So something with a longer payback period, but that then pays a lot, you might, it might not be, as reflective when you're comparing it to something that is not quite as profitable, but it pays back faster. Payback is simple when the stream of payments are going to be constant. You just divide the, the amount invested by the number of payments you get over the years. So if you invest $100, like in the example we were using, if you invest $100 and you generate $10 a year, all you would have to do is divide that $100 by $10, and it's 10 years for payback. But for non-constant stream of payments, it's a little bit more complicated. You would look at the number of negative cash flow years. So the number of years that your cumulative cash flow is negative. So if you invest $100, and you get $10 back, the first year you're now at negative 90, the next year you're at negative 80, next year you're at negative 70, the next year you're at negative 60. So you find that the last year that you're at that negative cash flow, which in this case would be that 10th year, right? And then you take the cash flow the next year, which in this, the example we had would also be $10, and you would divide those two, and that would give you the fraction of a year. So in this case, you would need to know that, it's the same, it would be the same thing. And I'll show you this in a chart. So you can see this is the same thing. So this, so you have these two investments. They're both $10,000, initial $10,000 investment. So, and then the cash flow for this investment here, if you get $50, it's a much slower, you're not getting much money the first few years, and then you start to get more money as time goes on and it becomes more productive. And then this investment, you get an even stream of cash flow over the year, over each year. But you could see the way the formula is, what you could do is you could just add these, since you're getting $2,000 a year, you could just divide $10,000 by $2,000 and you would get 5, right? It's 5 years to pay back. Or or you could do the stream of payments, so there's 1, 2, 3, 4. It takes 5 years, right, to get to that last year where there's no payment. Whereas with this one, you have an uneven stream of payments. So you have to first, you calculate how many years do you have negative cash flow. So, from your initial $10,000, you're subtracting the amount that's coming in every year. And it takes you 11 years that you have negative cash flow. So your 12th year is your first positive cash flow year. And so you would get $5,000 this year. So you have negative 4,500. You get $5,000 this year. You would divide the 4,500 by the 5,000, and you get 0.9. And so it's 11.9 years, just so you can actually know what fraction of the year you actually get paid back. In some cases, that would give you a sense of like, is it going to be like towards the end of my 11th year or the beginning of my 11th year that I get paid back? But you can see that when it's a non-even stream of payments, it's a little bit more complicated than when it's an even stream of payments, but it's conceptually not really that complicated. You're just want to know what year you are, you're finally you finally are entering that positive stream of cash flow. So the payback periods for these two investments, this investment has a much faster payback period than this investment does. If you look at these two, the internal rate of return, however, I used that same formula that I used earlier to calculate the internal rate of return. And an investment A has an internal rate of return of 8%. And B has an internal rate of return of 5%. So, so the finding something that, so these have different, what's the word I'm looking for? These, they do have different internal rates of return. The net present value, you can't really compare these two. They both have positive net present value. So they're both investments that are positive as far as being investments, but you can't actually say that you're looking at net present value, you can't say that B or A are better investments looking at these amounts, because A is a much longer period of time than B is. And so you have more stream of payments over that period. So in order for these to be comparable, you'd have to know what you did with the money over these ensuing years to see whether or not this stream, so if you were to reinvest this, now your stream of payment into more money, are you better off? So you can't compare these two. All you can say about these two is that they're both investments where the net present value at I think I did this at 5%. They're both investments that you could consider. If you're 5%, if your threshold is 5% for internal rate of return, they are both higher than 5%. This one has an internal rate of return of 8%, but this one has, but option B has a payback period that's faster, which could be important to you because that might give you the money then to invest in something else more rapidly in the future. So with that, I don't know if there's any questions. I know I've gone over these concepts pretty quickly. If you have specific questions about any of them, I'd be happy to answer. So, but the key thing I want to leave you with is that it's important when you're looking at investments that are going to, really, have a stream of income and that you're relying on that stream of payments in the future. The real power, especially of internal rate of return and net present value in particular, is it helps you not overvalue that future stream of income. And so it makes it so that you are more being more realistic about about what the actual return for that investment would be. And so that would, at that point, you could determine whether or not, given other things you could do with your money, is this still actually really a good investment? Without putting in that, that sort of cost of money, and basically without taking into account, those are what we call economic costs, sort of that accounting for your other opportunities. You would tend to overvalue investments. And so this is really important, I think, for that, to help you not overvalue investments that are longer term investments. So great. Well, with that, I just want to make sure that you do know we have the hands-on workshops that you can register for in January and February, and that would be in person, where you can actually have an opportunity to to use some of these tools and practice them with other farmers. And I think that would be it's hard, I think, in like a half an hour to really understand things, but in a chance to like really sit through and think through scenarios, I think there would be, more opportunity to really, see how you can use these concepts in your farm and play with Excel and some of the formulas. So with that, I thank you for your time and hope to see some of you this winter.